Real estate investment practice problem using OneNote. Amortization schedule, where we change the payment and look at the impact on the rate, keeping everything else constant. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the practice problems down in the 4140 amortization schedule PMT change impact on rate tab. Also note, when using OneNote, take a look at the immersive reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations then on down below. We're now going to be switching things up a bit from what we have seen in the past and how these worksheets are normally going to be set up. That being that we'll have our information up top that will feed into the calculation of the payment. This time, we're going to be manually inputting the payment, possibly budgeting for the amount of we think we can afford, and then changing one of the variables up top, keeping the other variables held constant. We will start off by changing the rate. So in other words, we're going to be typing in, instead of having a formula in the payment area here, we're going to be holding the loan amount and the months or the periods constant, and then we're going to be adjusting the rate to whatever the rate would be, keeping everything else set up, and adjust the rate to what it would need to be given the other factors. Now note, this is going to be different than what you would see in a normal type of calculator online. This isn't a way that you could typically set up, because an online calculator normally has the data as we have seen in the past, which would then calculate the amount of the payment that you would get in that format here. But if you set it up in, say, like Excel, you can do other kind of variables if you so choose. We do set this up in Excel, so if you want to work through that practice problem, you can. We will have some more formatting and stuff that you'll have to go through to comprehend it there. And or if this looks interesting and you want to use the Excel worksheet, then you can go use the Excel worksheet for any purpose that you would like to do. So we have our information up top. We're going to have the home price is going to be the $400,000, 20% down. That means the down payment is going to be $80,000. $400,000 minus the $80,000 is the loan of the $320,000. We're going to have the 30-year. That's going to be fixed. We're not going to be changing it. 30 times 12 would give us months of 360 periods. The thing that is going to be changing is the rate, and then we're going to be manually inputting the payment amount. So this payment amount is manually the thing that we're going to be changing, and then the rate will then be affected or change automatically with the change to the payment amount. Now the rate then formula is going to have this formula in it, which will be related to the payment formula. It's a present value type of calculation. And so it'll look something like this. It's going to be equal to the number of periods. The number of periods would be then referencing the 30 times 12, or in this case, simply the 360, comma, to get to the next argument, the PMT or payment amount. That now is going to be down here that we're going to put in this cell, the 2,000 in this cell. Also note, it needs to be a negative. You can't put that negative just in front of the R like we've seen in the past. Won't work. You got to put it in front of the payment item or it will not calculate properly. Then we're going to say comma. Next argument is the present value. You'll recall that's the loan amount, not the home value, but the loan amount at the 320. We're going to close up the brackets. That would give us the rate for the months, because all this data up top, 360, is in months. We want the yearly rate, so we're going to then multiply it times 12 to get the yearly amount. That at this point is going to give us that 6.39. That's rounded because note, it could have more information, more decimals if we were to calculate this in, say, Excel. Now the total payments and the interest we can calculate down here as always in the same fashion we've seen in the past, because if we say 2,000 payments times 360 of them, we got the 720,000 minus the loan amount, which is 320,000, gives us the total interest over the life of this thing, 400,000. But obviously what we really want to see is it broken out period by period, year by year. So then we might also want to see this information in terms of the payment amount, which we're just going to basically hard code here, and then look at the rate, or what the rate would have to be given everything else held constant up top. So we can put our table together here and say, I'm going to just increase the payment for this example by starting 600 and up by 200 each time. So we've got our payments. This might be our range of payments that we think that we could afford, for example. Hold everything else constant and see what rate would we need in order to basically make that happen. We would have our same calculations we did up top with the rate, but they would look something like this. So we're going to say the rate is now going to be the number of periods. So the number of periods is going to be an absolute reference with the dollar signs. That's going to be referencing this 320. It has the absolute reference because we don't want it to move down as we copy the cell down, comma. We have the payment amount. That's not an absolute reference, and it would just be taking the item to the right. In this case, I believe it's the 2000, and then it also has to be a negative number. And then comma, the present value, loan amount coming from the data up top is going to be the 320. Also an absolute reference because when we copy it down, we don't want it to move down, dollar sign for the B and the 4. And then we close it up, we multiply it times 12, and we're going to get this 6.39 again. Same calculation we got up top. We can also set this up to give us that nice little drop down calculation. So we can put a drop down here to pick up from our payment numbers so we can double check our payment numbers, for example, here to the data up top. The data up top is what's going to be used to be creating the amortization table. If I was to copy this formula down from the 6.39 cell to the 7.33, we get the same calculation moved down. The rate, number of periods, same cell reference because we got the same number of periods from the data up top, the 360, comma, payment. This one has moved down from A22 to A23 because it's moving down from the 2000 to 2200. And then the present value is absolute same B4 with the dollar signs because it did not move down. That's the loan amount times 12. That would give us our percentages, so we can do that comparison side by side on the percentages. So next thing we could take a look at is the creation of the amortization table. So we won't go into the creation in detail, but we would do the same kind of steps in order to pick up the amortization table. We can make it into a table, use the filters or then the slicer to break this out on a year-by-year basis. This giving us then, of course, the payment amounts, the interest amounts, the loan reductions, and then we can break that out on a year-by-year basis as well. Scrolling all the way down, here's our year-by-year calculation. If I just look at year 2 with the slicer, we could see the total for the payments, the interest, the loan reduction, the loan balance for year 2. We could do it for year 4, for example, and so on and so forth. We have that in Excel if you want to look at that worksheet or just use the worksheet or create the worksheet. Next, we can then add the pivot table if we so choose, and we won't go in detail on how, on the steps to do that because we've seen that in the past. But the pivot table can be a functional, very useful tool, which we can then get our information broken out by year and then get the total payments, the total interest, and the loan amount by year, the loan reduction and the loan balances at the end of the 30 years. If we so choose, we can make changes then to, say, the payment amount here. If we change the payment amount, possibly with the drop down that pulled it from our list of payment amounts, it would then hold everything else constant, change the rate to whatever it needs to be for that payment amount to work. In this case, 2.11%. That would adjust the amortization table. We can then right click if we had our pivot table up and adjust the pivot table, which might give us a nice quick look at the 30 period data. So we can do a side-by-side comparison with something that doesn't have 360 periods. So if you want to take a look at that worksheet, then you can look at that and put the pivot table together, which can give you some more detail if you're doing some more in-depth analysis. If we changed it to 1,600, for example, and refresh it, then we've got then the rate now should be 4.39 in order to make that work. And then we can refresh the pivot table and we would have our information related to the interest and year-by-year breakout for that 1,600 payment. And then if we change the payment to 2,000, then once again the rate goes back and adjusts as needed given the other data to 6.39. We can adjust then the pivot table to get the year-by-year data, and then we can use that to make other tables that we might want to do. For example, if we had the rate changing and we wanted to then say that we had a 320,000 loan amount, 320,000 rate is the same, what would be the interest payments if we had a payment of 1,200, 1,600, and 2,000. So in other words, if you hold the amount at $320,000 and you change the payments, then and you let the rates then alter or change automatically with relation to the payments, then what's going to be the year-by-year breakout for years 1 through 30, given these payments amount $1,200, $1,600, $2,000 on the year-by-year breakout for the interest, and the year-by-year breakout for the loan balance, the balance of the loan at the end of each year for those three settings. So that's just one example of the kind of things you can basically look up with a table like that. A little bit less conventional table, because again, most of the time they calculate the payments, but you can reverse the factor. You could say, hey, I know what I want to pay and I want to back into what rate I need, or we can back into what loan we might need if we have the payment, which we might do in a future presentation, or back into the term using these formats. Again, if you want to look at how to create this table, we do it in Excel. If you want to just use the Excel worksheet and see if you can use it for your own needs, for whatever you want to do, check it out.